I'm joined by my colleague Karen Manczko, who will provide an update on the Wespath fund performance. Karen, thank you for being here.
Thanks, Joe, and greetings, everyone, from a very cold Glenview, Illinois.
In our market update, our colleagues Frank and Johara discussed the continued economic resilience we've experienced and the positivity that stemmed from declining inflation. They zeroed in on some weak points and reasons to be cautious about too much optimism as we start this year. However, there was certainly a lot of encouraging upward trends in the fourth quarter. How did this positively reflect on the Wespath funds?
That's right, Joe. Global equities finished the year strong with an Uber Bowl run in November as investors gained confidence in a soft landing. All equity sectors were up for the quarter, with U.S. equities ending 26% higher for the year and non-U.S. developed equities up 18% on the year.
In bonds, at the end of the third quarter, returns were negative, but it looks like fixed income also ended the year strong as well.
They sure did. November was really an everything rally month. Equities reversed the losses from earlier in the year, and bonds were up as well, finishing the year in the green.
You mentioned that there's growing optimism for a soft landing, which for viewers we would define as an economic slowdown that cools inflation but doesn't cause a recession or sharp sell-off. What are some of the other reasons for these strong returns in stocks and bonds?
As I mentioned, the dovishness of the Fed definitely supported the markets, but we also saw inflation concerns easing as inflation itself appears to be cooling. Inflation peaked mid-2022 at 9.1% and fell to 3.1% in November of 2023. If we think back on 2023, we started the year gearing up for a recession. By the summer, the consensus view was rates higher for longer, and by the end of the year, everything shifted with the cooling inflation and now calling for a soft landing. It's been an emotional roller coaster for us investors, to say the least.
All right, let's turn the topic to the Wespath funds. Can you give us an update on how all this impacted us for the quarter and also for the year?
Of course, but before I dive into that, I do want to explain to some of our investors that we're going to report and showcase our long-term fund performance. And this is going to be our composite performance figures. Our composite reflects both P-Series and I-Series performance combined on an asset-weighted basis. Investors in the I-Series funds will be familiar with these, since we show these composite information to reflect a longer-term history of the strategy. For P-Series investors, I just note that the I-Series funds have substantially similar investment objectives and strategies. Now, let's take a look at the results for the quarter and full year. You can see that the Wespath equity funds ended in positive territory for the quarter and 1 year, with both our U.S. and international equity fund composites up over 10% and 9% and 22% and 12% net of all fees. The U.S. equity index fund composite was also positive for the quarter and year and returned over 12% and 26%. Despite the positive absolute performance from the equity funds, they did underperform their respective benchmarks net of all fees for the quarter and 1 year. For the quarter, the U.S. equity fund composites overweight to small and mid-cap stocks contributed to the performance as we saw small and mid-cap stocks outperform large cap for the quarter. With this said, the fund's underweight to mega cap, specifically Microsoft, Amazon, Nvidia, and Facebook, detracted as these companies returned 14% to 19% for the quarter. Unfortunately, the two equity fund composites allocation to private equity and private real estate detracted as these valuations on these asset classes in both the U.S. and non-U.S. could not keep pace when we see strong public market and these asset classes are lagged. This was the main detractor for the quarter for the international equity fund composite. I'll spend more time talking about the specific contributors and detractors to the year-to-date performance in a moment.
So Karen, you mentioned that the fixed income fund also ended the year higher with a very strong fourth quarter. Can you tell us a little more about the quarter and the 1 year performance for both bond funds?
Yes, fixed income markets performed remarkably well in the fourth quarter as inflation tempered, central banks signaled the end of the tightening cycle, and the economy remains resilient. Therefore, both composites were positive on the quarter and 1 year, which was a great turnaround for this asset class. The fixed income fund composite was up over 6% for the quarter and almost 8% year to date.
So it's great that the fund returned positive numbers for the quarter and year to date. And what were the specific drivers for performance?
This was really a risk-on quarter, not only for equities, but also for fixed income. The composite is primarily actively managed, therefore the collective work of our active managers and their issue selection, along with navigating the yield curve and duration in this challenging environment, has really benefited our investors. Also, the meaningful decline in yields pushed bond prices higher, benefiting performance. The composites benefited from the overweight allocations to and selection within high yield and emerging market during the risk-on quarter.
All right, so before we move on, are there any comments about the other bond fund, the Inflation Protection Fund?
Yes, a few quick updates. As I mentioned, the Inflation Protection Fund ended the quarter and year in positive territory and outperformed its benchmark for both time periods. The composites underweight to U.S. Treasury inflation-protected securities and the out-of-benchmark allocation to emerging market inflation-linked bonds helped relative results. The non-dollar exposure also helped as the dollar weakened versus a basket of currencies during the quarter.
Thanks, Karen. So before we talk about specific contributors and detractors for the years, let's get a sense of where we are compared to others in the industry. Can you tell us how the multiple asset fund compared with other balanced funds?
Yes, of course. This next chart showcases the multiple asset fund composite versus a universe of balanced funds. This slide measures how our balanced fund composite performed relative to other balanced portfolio and funds that are currently on the market. Looking at the chart, you can see that the multiple asset fund composite has performed above the median across all time periods, with the exception of the 3-year, which was below, as you can see from the chart. But the 10-year time horizon, the multiple asset fund, outperformed 58% of its peers.
Great, thanks, Karen. Now let's think about those contributors and detractors to the fund's year-to-date performance. Can you break down what helped and hurt the fund in 2023?
On a gross of fees basis, the multiple asset fund underperformed by 69 basis points in 2023. No surprise that the positive contributors to the fund's relative performance was the outperformance by our two fixed income funds, which comprised 35% of the multiple asset fund. The primary detractor to performance was the equity funds, which I'll talk specifically about here in a moment.
Right, so let's dig into the equity fund's 2023 performance.
Starting with our U.S. equity fund, this fund underperformed its benchmark by over 200 basis points for the year. 5 of the 6 active managers outperformed, which was a contributor to the fund's performance, but the fund's overweight to small and mid-cap stocks and corresponding underweight to mega-cap stocks was the biggest detractor, as we saw these stocks return over 96% for the year. Also, the fund's allocation to private markets detracted. These assets are updated on a 3-month lag, and therefore we have not seen the strong gains posted to this asset class yet for the fourth quarter.
So the mega caps ended the year posting some really strong results, up almost triple digits per year update.
They really did, Joe. These Magnificent Seven, or so they're coined, stocks comprise 28% of the S&P 500. As Frank and Johara mentioned earlier, if you take the S&P 500 and equal weight all of the companies, then the index would have only returned just under 14%.
So it sounds like these 7 names are fairly concentrated in the index.
They are. They make up 2/3 of the S&P 500 returns and have really been dominating the U.S. equity market.
So you also mentioned that the International Equity Fund underperformed its benchmark for the year. What were the drivers of that fund's relative performance?
The International Equity Fund underperformed by 208 basis points. The primary reason for the underperformance was stock selection by our fund's active managers, particularly in utilities and industrials.
So it sounds like active management played a big part in the international fund's underperformance. Are there any other contributors, detractors that you'd like to highlight before we move on?
Yes, the fund's allocation to private markets, similar to the U.S. equity fund, also detracted due to the lag in valuations for this asset class. A positive contributor was the fund's ethical exclusions, particularly not investing in tobacco companies, helped the relative performance of the fund.
So now let's talk about bonds and the 2 fixed income funds and how they performed in 2023.
As I mentioned earlier, the fixed income funds had strong absolute and relative returns. The funds benefited from its overweight allocation to high yield and emerging market debt. 6 out of the 8 strategies outperformed too. The fund's active managers' issue selection also contributed specifically in investment grade credit. The only detractor was the fund's allocation to agency commercial mortgage-backed securities.
All right, so let's move on to the final fund, the Inflation Protection Fund.
The Inflation Protection Fund outperformed by 194 basis points for the year. As I mentioned, risk on assets did well, and therefore the underweight to U.S. TIPS and out-of-benchmark allocation to emerging market inflation-linked bonds helped relative results. The exposure to non-dollar also helped as the dollar weakened versus a basket of currencies for the year. The floating rate leveraged bank loans also contributed. These loans pay a floating rate of interest. Therefore, as short-term rates move higher, so did the coupon payments of bank loans, making them particularly attractive to investors in 2023 and contributing to our fund's relative results.
Thanks for that performance summary, Karen.
Thanks, Joe.